So if you're new around here, you'll know that I am building a dividend portfolio that is publicly on my channel, sharing the ups and downs of the passive income along the way. But today's video isn't about the big portfolio. This is for beginners, it's for people starting off and to understand that you can start off with a smaller amount and then you can build it in the right way. Let's break it down. First section we need to kind of cover is where the bloody hell do you do it? Well, that's up to you. But I'm going to give you a couple of answers. Easy answer is the stocks and shares ISAs, and we will go through that in a little bit of detail, but not too much because I've already covered it. Basically, tax-free growth, all that kind of good stuff. Any dividends, any capital gains, you are not taxed on, which is kind of the whole point, yes? So, it's like an ISA, but it's obviously different to your retail high street ISA where you just put cash in it, okay? So, let's talk about on the channel. If you're not yet done so, please do leave a like. Please do subscribe. It majorly helps. And let me know what platform you're using if you're looking to do anything like this. But I did a video 3 days ago, the ISA you need, that was going through 7 of the ISA platforms that are available. You've got stuff like Vanguard, Trading 212, Free Trade, you got Invest Engine, the lot. It's all there, all covered. That is where you need to start. But different beginner points, different pain points, learning curves, whatever. Personally, I'd say Invest Engine for beginner-friendly ETFs, Vanguard as well, because you can use their own funds and the fees are relatively good. But if you do want more variety, Trading 212 is the predominantly one that I use, but I use individual stocks. But I am open to doing a challenge on a different platform, not using the ISA platform, but a general investing to showcase the growth in funds over time. So in terms of boring but steady and a low risk option, these are kind of what you should be going for realistically in terms of the obvious in the room. This is basically the super diverse global all cap index fund. Long story short, it covers the whole entire market. A low cost fund. You can get it on Vanguard. You can get it on pretty much any ETF platform, realistically just covering the entire stock market on Trading 212 Invest Engine. And as you can see, it covers over 7,129 stocks, which is good. Now, the downside to all of this is obviously it is the entire market. The entire market, right? But price performance does indicate that they do go up over time. And as you can see over the course of the last 6 months, the last 12 months, there's been cyclical drops and rises over the course of time, which is why we need to talk about further things in this video, such as compounding and time. Time is a big factor, but we will get onto that in more detail. Now, the good thing with this is, as I say, decent amount of data, good information, because it's been around for quite a while. This fund was created in 2016. It's got 5.2 billion share class assets. So it's not likely to just vanish over time. It's a trusted one for Vanguard. But as you can see, past performance, you know what happened here with coronavirus and stuff. It's not been too bad, and over the course of where we are right now, we're at 7%, which isn't too bad at all. So overall, as you can see, it has been going up more than down. There's always going to be cyclical bouts of poor performance in certain situations, but there is also a very, very, very small dividend distribution. So a very popular one in the UK is basically a UK dividend fund, kind of ish. 102 top performing UK stocks. The ongoing charge is relatively low as well. Risk factor of 5. And again, you can get this sort of fund on most platforms as well. Now, performance on this one's pretty good. It will be more cyclical. It won't be as, good longer term in terms of if the market is more steady. If the UK market has a bit of a wobble, so be careful with your risk management here. You may want to go 20% in this one, 80% in the other one, or whatever suits you. Now, personally, I would probably split it more 30-70, but for me, as you can see, overall, it's done pretty well given the time. Now, the main factor to this one, obviously, yes, you got the price factors and all kinds of stuff. Yeah, that's fine. But we need to talk about the distributions. The distribution of 3.38% yield is actually relatively good. And if this isn't a stocks and shares ISA and you're getting that distribution coming through, that's pretty good. Realistically, that is pretty damn good. So whenever that is getting distributed, reinvest it. It will grow your portfolio. This, for me, is a very obvious sleep easy at night sort of vibe with both of them, and you can probably just sit and relax with them. Now, not financial advice, of course, but we do have to talk about more high risk and more high reward, because I know that some people in the comments will go, oh, you took the easy route. Now, we've got to talk about technology. Right, we're going to do 2, 3, 4 funds essentially. I'm just going to give you some options. And the first and obvious one is the NASDAQ, obviously the technology side of the market. And Yeah, you could argue there's a lot of funds in here. There's a lot of money in the technology market, and they have done very, very well. And the higher risk with this is the fact that they are more cyclical. They are likely to drop. Performance of this though has been relatively good, and as you can see here on this platform, if you put $10,000 in at a certain point, you've made a lot of bloody money. And the reality is here, it's still actually going up in terms of value. You can see here in terms of the index and the ETF. It's been pretty damn good. Look at the overall growth here, 5 years, 3 years. It's been pretty damn really good. But then again, there is more drops than there is rises at certain points. So just be mindful of that. Annualized, you can see here, again, relatively good. So it is a very, very strong one, certainly when you look at technology. The downside to this, as I say, can you manage the fluctuations and the drops? Going on to technology, and this is a random fund. It's an equal weight mega trend sort of fund where it covers essentially AI, blockchain, and really, really speculative kind of technology. Now, as you can see here, 8 subsectors: robotics, automation, cloud computing, big data, cyber technology, future cars. A lot, right? So this is just, I wouldn't say invest in this, but I'm going to tell you, if you have a specific interest or if your job or whatever, and you understand a part of this world, it's not a bad thing to do in terms of understanding that, like, you believe that AI or robotech, whatever, is going to do well. Now, the situation with this is obviously there's lots of tickers. You can see all the little ticker codes here for different markets, London Stock Exchange, and it is a real fund. It is a legitimate thing. It's been around for a while. But the price performance is a little bit more scary. There's a lot more pushes, there's a lot more pushbacks. It's a bit crazy. So just be mindful of that. You will have to manage these sort of funds more if you are looking to grow a part of your portfolio as a bit of a riskier hold. Simple as that. So even though we're talking before about a 20-80 sort of split, depending on the safety side of it, you may only want to put your part of your portfolio like 2 to 5% on these sort of things, because they're crazy. And if you follow me, you'll know that I do blockchain stuff. I invest in crypto, but I also invest in the ETF for the blockchain, which is on Wisdom Tree. Again, similar sort of idea. If you have an interest in a certain specific element, go and look at the funds. There's loads of them. There's loads of funds like this in terms of different kind of niche markets. Certainly worth looking at. So let's talk about some common mistakes and things that I see all the time, certainly as an investor. And I've been an investor for a long, long time now. Don't overthink it is the first one. And the obvious one, people try to find the perfect investment, right? A lot of people look and try and find the biggest yield or the biggest growth in the fund or whatever. Don't overthink it. You've got to literally buy it and do nothing and just get started and get used to the idea of doing a regular motion, which is invest more over time. Now, the other obvious one for me is do not check it every single day. And I think everyone does that. If you want to have a hobby, get into baking. Don't sit there and watch your £1,000 or whatever you're investing bounce up and down a couple of pounds each day. It gets very, very boring very, very quickly, and it will just kill the fun. And another thing as well, people ignore fees. You need to look for funds that have relatively low fees and management fees. There's a lot of platforms out there that will gobble you up. They'll talk about managed fees where they'll manage it for you. And realistically, they will eat into smaller portfolios fast. If you've got a big portfolio, that is fine. But Vanguard versus, say, some of their managed funds are quite pricey versus, say, a trading 212 individual fee structure, as an example. Same with Invest Engine, right? They're relatively competitive too. So if you've got small cash, don't be putting on managed funds because you will get eaten alive. Now, we need to talk about consistency and compounding. This is where the crux of it is. And this is obviously just a starter kit. It's not about that £1,000 investment, because if you just put £1,000 in and expect to get rich, I'm sorry, you're not going to grow wealth anytime soon. Now, once your bills are paid and once your expenses are out, you need to start looking at drip feeding a part of your money into the markets. That's kind of how you grow your wealth and you beat inflation, and that's how money grows. Obviously, you need to keep some cash and capital as an emergency fund. And if you want me to do videos about stuff like that, let me know. Now, let's talk about some quick building maths and a very, very obvious chart that will probably make more sense. Now, on the screen, it's relatively straightforward. You've got once at the bottom, which is the yellow line. Long story short, if you invested once and you get an average of 7% growth on that over 20 years without many dividend yields or reinvesting, you're only going to have £3,000, £4,000, give or take. Now, if you are going to put £100 per month consistently for 20 odd years, you're going to get over £50,000 as the power of consistency and compounding. It's boring, but it works, shows what it does, right? It's just like going to the gym or brushing your teeth. It's small effort. It gives you a little bit of a reward. No one wants rotten teeth, but let's be honest, if you're going to invest £1,000 in just once and never touch it again, nothing's going to happen. Let's be honest here. So that's what I'd do. I would look at the first entire funds of the entire stock market. If I was a beginner right now, starting right again, I would do that. I'd also look, as I say, at the UK top dividend investing stocks, which offers a very, very decent yield and overall price performance, which makes sense. And let me know if this has helped you, because I think a lot of people with investing, they just want to get rich quick, but ultimately there's more to it than that. But you do have different growth funds out there depending on the niche that you're in. So it just makes sense to kind of look at different ones, what you prefer. Or if you want to be more of my approach, individual stocks, manage them accordingly. It's entirely up to you. And let me know in the comments, what did you do initially as an investor? I'd like to know, and what funds you like to be in.